So what we have now, Tyler, is the language in the Senate bill that will create these lending facilities. This is not just the Main Street lending facility, but it's the broad lending facility that the Federal Reserve will establish. First of all, the money. It's $454 billion, which is more than was initially talked about. By the way, this is the latest bill. There may yet be changes, but this is what was received by Kayla Tausche not too long ago. Let me give you the details of who is eligible and what kind of restrictions. You don't get money from Uncle Sam for nothing. Loans up to 5 years, but in any case, as short as possible. You would get an interest rate that would be comparable to a similar risky loan at a rate that would be before the outbreak of the coronavirus. The Treasury Secretary is supposed to publish the procedures for applications within 10 days of passage. Let me go on and give you some more. The company receiving the loan cannot engage in stock buybacks or pay dividends to its shareholders over some period of time during the loan and after the loan. The expectation here is to maintain employment if you get one of these loans, the level as of March 24th, 2020, or to the extent practicable, but not in any case less than 10%. And there are limits on executive salary increases that are actually pretty detailed. If you make like $425,000 last year, you can't get a raise this year. And if you made more than $3 million last year, an executive can't make more than $3 million while they get these loans. They're very detailed, but really, Tyler, this is just the beginning. These rules and regulations now go over to the Fed, and the Fed has to figure out actually how to get this money out to Main Street and regular businesses here that have trouble getting loans and staying in operation.
One question, if I might, and then one observation, if I might.
Just
Steve,
one?
Well, that's all I can think of right now. I've got limited bandwidth. But let me ask you the question. The question is there anything in here that says if a company avails itself of these loan provisions that they have to pledge not to lay off workers?
Yes, there is. So there's this thing in there that says a recipient of the loan must maintain the level of employment as of March 24th, 2020, to the extent practicable. And there's actually two different sections on this that I've read. But you can't reduce your employment below 10% of what, or 10% from where it was on that date. There's another one that says for medium-sized business, they have to maintain 90% of that level. So there's the idea you get the loan, you have to maintain your employment level.
I'll save my observation for our next conversation as you stay with us and we bring in Lindsey Piegza, who is chief economist with Stifel. Lindsey, welcome. Good to have you here. My observation was this: as Steve just described this package of a lending facility of some $400 billion. One of the things that was in there was an agreement on the part of the companies to take these loans that they will not pay dividends. That would be a big pill to swallow for a lot of companies. Now, obviously, small businesses that aren't paying dividends, that's one thing, but big businesses that do is completely another. What do you think?
Well, of course, we would expect a lot of restrictions to come with these loans. This is not intended as a corporate bailout, but as a bridge loan to assist these businesses to, by extension, then help workers and get the economy back on track. So I think it's very important that we do have these restrictions in place. But as Steve mentioned, there's also a timing issue with this bill as well. When is the bill passed? And the question is, when are these checks to individuals or these loans to businesses going to be hashed out? It could be weeks before we see some of these funds received. And again, during that interim, the economy will continue to suffer the pain of being shut in, with individuals sent home, businesses, doors closed. So while I do think this is going to provide a lifeline, a welcomed lifeline for many, it's hardly a panacea, and the economy will still suffer an incredibly intense blow, particularly in the second quarter, even as the market seems to think that this is the best sort of scenario that the government could provide.
I'll come back to you on the question of how intense a blow it will be. Steve, jump in, but let me tee it up with a question, and that is this. Yeah. Is there a possibility, or how would you handicap the possibility, that the restrictions in this package would be so off-putting to some businesses that the whole thing could backfire? I mean, I don't mean to be a dire here, but
I think that's going to be. I think I think that's going to be possible, Tyler. I think people are going to, some executives will look at this and say, you know what, I don't want to take a salary cut if I make $4 million down to $3 million. That was my reading of it. I believe that's correct. Some people said, well, I made $425 last year. I may deserve to make more this year. I don't want to not pay dividends. I don't want to not do share buybacks. And then there are going to be some companies say, you know, it's the only way to do it. And I think what Lindsey was getting at was this general notion, if you're going to borrow from the government, it should hurt a little bit. It shouldn't be, you know, the easiest thing to do. The government shouldn't be easier than the private sector in some cases. And you get this money at a rate that's lower than it would be right now if you were going for that rate. But you go back to where you were before the outbreak.